It's panic at the top. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, government is on the edge of collapse, and I want to understand why this is so urgent, because the economy is facing total economic destruction, which is going to lead to a mass uprising, and then you'll see the government come toppling down. I'm going to show you the panic move the government just made and why it has no chance of working. But before we get to that, I want to head back to yesterday's story where we find out it was indeed all about the money. Now it's over to Bloomberg, where we picked today's story up on the headline, as Harris has enough delegates to clinch the nomination for president. Remember, I told you this was the likely outcome yesterday, and it has everything to do with about $96 million. Harris sealed her status as a presumptive nominee Monday night after crossing the magic number of 1,976 pledged delegates, this according to an unofficial tally. While delegates who indicated their support are not required to back her nomination, the achievement and lack of credible opposition underscores the vice president's hold on the Democratic ticket. And I want to understand they have no choice but to go with her, because if they choose anyone else, there's $96 million that doesn't pass to campaign funds. This is an all but certainty that we will see Vice President Kamala Harris win the Democratic nomination, as she took over Biden's campaign, which was renamed Harris for President, giving her access to its $96 million war chest, providing evidence this is all about the money. She said that the campaign's leadership chair, Jennifer O'Malley Dillon, and manager Julie Chavez Rodriguez would remain in place, giving her the chance to move forward. But as we have said, it's all about the money. And for our subscribers, well, that's all about making money, and you can too. Look at this from yesterday's close. We now have 3 open trades on CTA Timer Pro. The one we put up yesterday is only down just slightly. We added another one today, and we think this one has a ton of upside potential. Momentum Timer Pro sitting on 7 open trades, all of them up. 2 trades added today now, and we do think there's upside potential for them as well. And how do we do it? Well, we look at the machine positioning with our CTA Timer Pro. This finds some very deep entry points. When we find machines are massively short and price moves against them, it signals on our reports, and we review each one for you. But maybe you like to trade the technicals like the RSI and the MACD, but you find yourself getting in late and out early and all over the place. Well, look at Momentum Timer Pro, because we add a proprietary overlay to those signals. Here's 2 trades that got stopped out yesterday at a net 1.24% gain. These are outstanding results, and we look at momentum over different periods, and when we see a reversal, well, it flags our report. And here's the best part: you don't even have to know how to read the reports, because we give you all the exact information you need to place every trade. You get the report, you get the signals that are right on the report, but I give you my opinion on the best trades that you should do. We tell you when to buy and what your stop loss levels are. We keep track of those trades and the returns, and every week we update the stop loss levels for you. And here's the best part: you get a 30-day free trial. None of my competitors do that. They want you to pay to find out you can't make money. We want you to get it for free for 30 days, because we know you're going to make money. The links for both are in the description below. Check them out and get on your 30-day free trial. Start making money, because can Harris be blocked from the ballot? Well, the GOP ponders post-Biden lawsuits, because it's, again, all about the money. The Federal Election Commission Chair Sean Cooksey suggested there could be legal challenges over how much money contributed to Biden's campaign can be used. But one of his Democratic colleagues on the commission and conservative election law experts have disputed that. Harris has filed paperwork to update Biden's campaign committees to reflect her status as a presidential candidate. The oversight project of the Conservative Heritage Foundation posted online Monday that they are actively studying whether Harris's move was in accordance to the law. But of course, now we look over to China, where we're seeing a government on the edge of collapse, looking to make a very desperate and panic move, because their economy continues to head lower, and there's absolutely nothing that looks to stop it. And even worse, as I'm about to show you, the moves the government is making are not going to work, indicating that China's economy headed down. And when it happens, watch for a mass uprising that will bring Possibly. President Xi Jinping's reign to an end. As China surprises with a rate cut after Xi's big meeting disappoints. Well, it's hard to have a good meeting when your economy is heading into a recession and your banks and your housing market are about to fail. The People's Bank of China on Monday cut the 7-day reverse repo rate, a key short-term policy rate, in the first reduction in almost a year. And I want you to remember, they did not want to cut rates there. This was a huge issue for the PBOC because there's one thing that many central bankers believe they have authority over, and that's their currency. In this case, if you cut, of course, the funds rate, well, that means the market believes the currency is going to weaken, and already Beijing's have a problem because their currency just continues to head lower, and that is dangerous because if people lose confidence in the currency, well, they're going to lose confidence in the government. As Chinese banks followed the move about an hour later by lowering their main benchmark lending rates, making it less costly to borrow for mortgages and other loans. And here you can see the relationship that the market believes is true. Of course, we want to note that there's absolutely no authority that central banks have over the value of their currency. There's just a belief, and the system follows that belief, and the market trades it accordingly. But here you can see the federal funds rate shown in blue against the nominal broad US dollar index. So as we look at the Fed's correlation to the dollar, you'll notice there really isn't much of a correlation here. You can see the dollar was weakening ahead of the global financial crisis when the Fed cut rates. Many will say that's because the market knew the Fed was going to cut rates. But look at this. In 2009 and 10, the dollar came down and the funds rate was already at zero. It happened again in 2011, almost to 2012. Now, some might say that had to do with QE, but then look what happened after that. The dollar rallied. Of course, the argument then might be, well, it was front-running the Fed raising rates, but that happened about 4 years early. You can see going into the pandemic, the Fed cut rates. Well, the dollar really didn't move much at all, but that is still the belief, is that the yuan is going to come crumbling down. That will create a lack of confidence and further exasperate the move of money out of the country. This is something Beijing doesn't want, and you can see when people start believing the value of their currency and seeing it decline in value, well, the government's timeline of how long it's going to be around, well, won't be much longer. China has been stuck in the longest streak of deflation since 1999, with the economy-wide prices dropping for 5 straight quarters. Keep in mind what happens in China at the factory level eventually shows up here in the U.S. in consumer prices. That means real or inflation-adjusted interest rates have stayed elevated, weakening the impact of any moderate easing. And we predicted that they would have to cut rates there, even though they didn't want to. They were making a choice between trying to hold their currency up or cutting rates. What they don't understand is because the economy is continuing to slide lower, demand for the Chinese yuan is going down. That's the reason you're seeing it fall. It has everything to do with global trade and the global economy, not policy rates. But here we can take a look at, of course, the relationship between funds rates as we look at the Fed and the consumer price index here in the U.S. That's shown in red on a year-over-year rate of change. And of course, if you're looking to stimulate the economy, and in a debt-based economy at that, there's only one solution, is you need to get consumers to go out and spend. And usually the way that works is that you lower interest rates until there's a level that they're willing to borrow and go out and spend. But that's not the only condition. Let's take a look at what happens here, because you'll note that the Fed usually starts cutting ahead of a decline in inflation, but there is a point where they get the funds rate low enough where something in the economy changes and demand starts to pick up. One of the challenges we face is we've been at zero not just once but twice, indicating that the likely path for the Fed is going to be back to zero, and in a path to try to figure out how to take the funds rate negative, which we know they don't have the authority or ability to do, which indicates that the amount of quantitative easing we've seen during the last cycles is going to pale in comparison to what we see in the next cycle, because the only way to get the banks to free up money, as you're going to see, is interest rates have to go substantially lower. And analysts are forecasting further rate cuts and reduction to the reserve requirement ratio, something I said is going to happen. They have no choice because China's facing this issue of, do we try to save our currency or do we try to save, of course, our economy? Well, if you don't save the currency, well, your economy is going to go. And if you don't save the economy, your currency is going to go. Pick the lesser of two evils, cut rates, do it now, try to get things going before it's too late. And the reserve requirement ratio refers to the amount of cash banks must set aside. August and September are seen as potential window as a large amount of one-year policy loans will mature and could be replaced by the liquidity unleashed by a cut. The PBOC on Monday said it trimmed a clutch of interest rates considered the ceiling for borrowing costs known as the standing lending facilities by 10 basis points each. And the issue here has everything to do with the bond market and getting people to borrow money, because you look at a debt-based economy and you wonder, what is it that changed when we go back and look at the consumer price index? Well, what happened is all of a sudden the banks decided they would lend, and there was an eventual turnaround in lending, because if you want to expand a debt-based economy, you need to expand the debt. And to do that, you need the banks to lend and people to want to borrow. And here you can see what really happens. The mechanism underneath this is central banks. Here we're looking at the Fed, still showing the funds rate in blue, now against commercial and industrial lending for all commercial banks, shown on a year-over-year rate of change in red. And what happens is the Fed eventually cut rates low enough that the banks turn around and start lending. You can see that happens each and every cycle, suggesting again that there's a reason the Fed has to cut to lower and lower interest rates with each cycle, and that is to spur lending. If there is indeed an all-out collapse of lending in China or here in the U.S., look for central bankers to massively cut rates, which is why we continue to say rates here in the U.S. are likely going to zero, and somehow the Fed's going to figure out a way to take them even beyond, of course, the zero bound. The cut of the 7-day rate could intensify the PBOC's month-long battle to defend government bond yields from dropping further. I'm going to show you that is not how it actually works. The unrelenting government bond rally has caused the PBOC financial stability concerns weighed on the yuan and reflected a pessimistic view on China's long-term growth prospects. Now, what they don't realize is the bond market is reflecting growth and inflation expectations. But as yields go down in China, money leaves the country, and that is a huge problem. Of course, what's the issue here is Beijing can't figure out why the banks want to buy long-term bonds. It's because they're looking for yield, and they don't want to lend. And you can't blame them, because a bank's first role is to get their money back when they lend it. And if you look at a weakening economy, banks figure out real quick that people can't pay a loan back if they don't have a job and the economy hits a recession. But what Beijing doesn't understand is the bond market has been telling them you need to cut rates, which is exactly why we said the PBOC would eventually have to cut rates. Here you can see the market yield on 30-year treasuries, and you can note that they decline often in advance of the Fed cutting rates nearly each and every time. Right now, we're not seeing a big drop in 30-year, but if you start to see a decline in rates, look for the Fed to chase them down in a big way. The PBOC on Monday allowed banks to apply for a reduction or exemption from collateral requirements for receiving its one-year policy loans, which could help lower the demand for long-term government debt from commercial banks and help dampen any bond rally following the rate cut. But what we can see here is that doesn't work either. The problem here with, of course, the rate cuts is the PBOC doesn't know how low they need to take them. The issue comes back to the fact that short-term rates are higher than long-term rates, means, of course, PBOC needs to drive short-term rates well below long-term rates to get the banks to unclench the inverted yield curve, and that is the first step to providing credit into the economy. And you can see here as we look at the funds rate against the 10-year, 2-year yield curve, and anytime the red line is below that horizontal black line, that means 2-year yields are higher than 10-year, and that's abnormal. What you should see is that longer the maturity, the higher the interest rate. Of course, that's what you're paying for risk. So when you see the opposite, it tells you something's wrong. And you'll note that every time there's an inversion, the Fed eventually cuts rates. And what you can see is those cuts end up going to new all-time lows. In this case, we're going to see the Fed eventually be forced to cut because the U.S. economy is going to go down the same path. But in this case, what we note with China is as long-term yields fall there, it means that PBOC is going to have to take rates far lower than they want and potentially sacrifice the value of the yuan to save the economy. But what that could lead to is an all-out financial crisis, a mass uprising, and seeing President Xi Jinping perhaps again lose his place on top of the Chinese government. And here you can see why the yield curve is so critical, because banks make money on interest rate spread. So when short-term interest rates are higher than long-term rates, they don't make money lending. They have to charge other fees, but they love to make money on that interest rate spread. And so what we note here is you can see the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, this in red. And when that red line is above that horizontal green line, it means on net banks are tightening standards, and that means less credit is being created into the economy, and eventually when that happens over time, the economy enters recession. And what happens, and what I want you to see, is the Fed has to continuously cut rates until the point where banks on net start to ease standards, and that's where the Fed eventually stops, suggesting that at this point we're likely to see banks further increase their tightening standards until the Fed eventually cuts and releases all the pressure in the banking system so they can lend. When that happens, then you'll eventually see this economy stabilize and turn around. But until it happens, the U.S. economy is on the same path that China is. We're headed to a recession, and given the health of our banks and our commercial real estate market, we're likely to face an all-out crisis as well. But what the issue, of course, that Beijing has, and they need to hurry because their stock market is about to fall apart. As Chinese stocks slump amid signs the national team is pulling back, and we've told you before that you can buy all the stocks you want from a government perspective, but it's all just a temporary band-aid. The moment you stop, it's all over, and the steep losses are likely to be a taste of what is made to come without state support in a market that's lost momentum amid China's economic troubles and geopolitical risks. Investors have looked to the third plenum for a clear policy roadmap to end the property crisis and revive consumption, but the details released so far have fallen short of expectations. Investors tend to wait until there's clear improvement. There has been no negative news in the market these 2 days, just investors believe such 10 basis point cut is not enough to trigger a turnaround in sentiment. And even if there was a turnaround in sentiment, consumers have to believe that the economy is turning around. And in China, you're the world's largest exporter. So what do you need to see to be confident? Well, you need to see your factory new orders start to go up. You need to see the rest of the world recover. That is not happening. And so what we can see then is what the issue is with China's stock market is going to be the same issue that happens with the U.S. equity market as banks further tighten lending standards and constrict the creation of credit and money in the economy. Eventually, you get to a point where there isn't enough money to support equity prices, and the market and the economy come crumbling down. This is one of the few times where you've seen investors believe in the bullish nature of stocks and go all in, creating what arguably is the biggest bubble in history in stocks in the top 5, of course, largest stocks in the major indices. At some point, the U.S. equity markets are going to find the same problem that China has, is that prices of stocks are going to start crumbling down, and when they do, there's going to be nothing to stop them. And as we look at, of course, a lack of money return to the U.S. economy, as U.S. existing home sales now dropped to one of its slowest paces since 2010. And the slowdown came as prices reached another record in June. So as sellers look to charge more, buyers are stepping back, with median sale price now up 4.1% to a little over $425,000. Surprisingly, prices are growing even as more supply has hit the market in recent months, but inventory is still low by historical standards. Contract closings, so decreased 5.4% as evidence that buyers are tapped out, they cannot afford it, and they are not buying here, to a 3.89 million annualized rate. The data released Tuesday from the National Association of Realtors marked the 4th straight decline, and the rate trailed all estimates of economists because nobody believes that the U.S. economy is heading to recession, but what we find out is that where China is headed, we're soon to follow. The only difference there is China's economy is likely to lead to a complete uprising and a failure of their government. Well, stay tuned, we'll see, because at the rate they're panicking, China's about to make a lot more moves and a lot faster, because things there are about to go completely upside down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.